To all our viewers from the United States, Korea, and around the world, welcome to Global Money Talk by SamPro TV, live from the floor of the New York Stock Exchange. I'm your host, Remy Blair, and you're watching our live broadcast from the financial capital of the nation in New York City. We'll begin the hour with the market briefing for an exciting live coverage of the U.S. markets, and we'll then bring you the market insights for an in-depth conversation with market experts. And today for the market insight, we have Tai Wong, the independent proprietary trader, so make sure to stay on for the entire show. But first, for the market briefing, let's welcome J.D. Durkin, CBS contributor and host of Public.com. Happy Friday, J.D. We finally made it to Jobs Friday.
Yeah, we finally did. A very happy Friday. Not happy for all investors, unfortunately, because I think the selling storyline so far in September appears to be carrying over into this Friday morning session, but regardless, great to be with you here.
Likewise. Well, we've been talking every single day this week leading up to this jobs report, and in terms of the headline figure, it did come in below expectations, but it is still above the 100,000 level. And we also saw that unemployment rate dip lower to 4.2%. We saw interesting reaction from the stock market. Right now, we are down significantly for the NASDAQ, about 1.5%, and the Dow Jones Industrial Average is currently lower as well and is down by 0.1%. Meanwhile, the S&P 500 is off by 0.8%. So what do you make of the market reaction?
I mean, I think, listen, the storyline this week has largely been that I think investors have been in wait-and-see mode to see what this number looked like and to what degree does this reinforce the central bank's position of an upcoming interest rate cut. And then, of course, the conversation had been, well, if it's too big of a miss on jobs, maybe that opens up the door for what people call a jumbo rate cut of 50 basis points or maybe even bigger. It appears as if investors, according to the CME Group FedWatch tool, still looking for that to be closer to 25 basis points or 0.25% of a deduction off of the federal funds rate. But really, I mean, tech is a really big story here. You're watching the major tech companies really have a very hard session. Shares of XLK, that's the technology sector, are currently down, believe it or not, 2.3% right now on this Friday morning. Those losses are being accelerated by some of the key household tech names that we follow most closely. You see it there on your screen. We are looking at shares of Microsoft, which is 22% of this particular ETF, down 1.2%. NVIDIA is down 4% currently. Apple, Broadcom, Adobe, Salesforce, Oracle. Unfortunately, the list goes on of the big tech players in this particular ETF, all down significantly, down to the right in red territory on this Friday. And this right now is on pace for the fourth consecutive day for the S&P 500 to be in negative territory.
And I think it's really helpful for viewers out there to see that chart, as you mentioned, the what we're seeing in tech. So do you want to break it down for us? Why are we seeing this lower movement when it comes to the tech sector today?
I think there could be a lot of reasons, and one of them may not be much more complicated, that a lot of these names were simply already overbought. One of the key measures that investors use to determine whether or not a stock or an ETF is in a good position or if it's appropriately priced is to look at what's called its RSI, its relative strength index. And for a lot of these key names, a name like NVIDIA, a name like Microsoft, at times a name like Apple, that have had these incredible run-ups over different parts of the ongoing bull market, we've seen that RSI indicator go north of 70 for those stocks, and that's kind of a wonky trader indicator that maybe the stock is a little too expensive relative to its valuation and where it should be trading. And now we're starting to hear some of the longtime bulls on Wall Street, like Tom Lee at Fundstrat, say, well, let's keep in mind we do average a number of large pullbacks in the S&P 500 over the course of the year, and the fall, September, October, could continue to be a bit choppy as people take some of those profits from those tech names that have had such an incredible run-up throughout the better part of the last 18 months.
Yeah, and it's hard to believe, but we're only in the first week of September. We came back from the holiday weekend, and we only had 4 sessions this week, but we've seen lots of volatility as we came back from the weekend. And we got earnings out from Broadcom yesterday after the market closed, and we saw shares tumble as the chip company was the worst performer in the S&P 500 after its revenue guidance fell short of forecast. So tell us a little bit about what we saw in terms of the earnings report, and why do you think shares are down so much this morning?
I think we are in a part of the AI revolutionary cycle where it's not any longer good enough to beat expectations. You have to beat expectations by a lot. This was, by all accounts, a very good quarter for Broadcom. They beat on the top line, they beat on the bottom line, they've adjusted their forward-looking forecasts for revenue from $11 billion to $12 billion. That's all well and good, but if Wall Street had been expecting those numbers to be even better, everything is relative and perception drives the reality. So unfortunately, if you are an investor in AVGO, of course the ticker symbol for Broadcom, it's a day where you're like, it was quite a bit higher just a few days ago. The company going on to say that the third quarter results reflect continued strength in our AI semiconductor solutions and VMware. That was the highly touted acquisition for the company last year. But ultimately, we are seeing shares of the stock plunge on that revenue forecast that, again, while still very strong in and of itself, relative to where Wall Street estimates thought it was going to be, a bit more disappointing. Yesterday was the 10th most weighted name in the S&P 500. Still about that, but we are seeing the company now as the 12th largest market cap. It actually swapped places with Tesla in after-hours trading. Tesla is now the 11th biggest company in the world, Broadcom falling down to 12th.
Well, thanks for breaking that down for us. And you mentioned sky-high expectations when it comes to these earnings reports, and that's reminiscent of NVIDIA, and that is a name that saw plenty of volatility earlier this week. But here we are, and we are seeing shares of NVIDIA down just slightly compared to that sell-off we saw, and that was a multi-billion dollar decline in terms of its market cap. Now, you just mentioned Tesla, and in today's trading session, we are seeing Tesla shares down by about 4%. So tell us what's going on. When we look at the chart, it does appear as though shares are extending losses down by about 5% at the 11 o'clock hour.
Yeah, this is not a stock you're going to hold if you're exactly weak in the stomach. I mean, the volatility on Tesla stock is astronomical. You've got massive days where it's down 5% like you see it here, and you got a day like yesterday where shares of TSLA finished up 4.5% after encouraging news about rollout initiatives for its self-driving software in Europe and in China. That's a massive market for a revenue generator for the company here. That gave a bit of headwind, or a tailwind rather, for the stock in yesterday's session. We've also talked about this before. Tesla is a little bit of a wild card, right? Many people on Wall Street think it's a bit of a proxy of popularity for Elon Musk specifically, right? It's his only publicly traded company. So if there is something directly of a market implication based on other controversies or non-Tesla factors impacting one of the world's most important people, you may see that kind of reflected in how Tesla trades. So again, not for the weak of stomach to see how aggressively the stock goes up and how quickly it comes down. It is still down about 7 to 8% or so year to date, and pending regulatory approval, the company hopes to move forward with that software, the full self-driving software rollout that it announced yesterday.
And speaking of Tesla, as you mentioned, it is one of Elon Musk's company. So we're looking at the chart right now. We are seeing Tesla drop further, down nearly 5.5% on this day. But I do understand that Tesla's also hosting a Robo-taxi day in October to demonstrate their self-driving technology. So tell me what we can expect.
Well, I'm sure, I think if you're a Tesla investor, you would hope that the expectation is anything good that continues to talk about artificial intelligence to maybe drive a bit of optimism in the stock into a bit of a better direction. Robo-taxis is a fascinating technology, whether it's companies like Waymo or a lot of others that are trying to be in the space. I think the biggest hurdle to any of these conversations is convincing a skeptical user to safely get into a robo-taxi and feel completely at ease that a driverless vehicle is taking you around. I'll say, I drove in several Waymos out in San Francisco. I got to test ride in them earlier this year. You very quickly forget that there's no human driver at the wheel. The technology is really amazing, but I definitely understand that concern. And so look for Tesla to announce those exciting initiatives that matter a lot to the user base, really the fan base of Tesla, because I describe it as that. These are fans of the stock like that. But of course, also look to kind of assuage any of those concerns. If you're going to scale, you have to convince a lot more people out there that the technology is safe to use.
Well, that's interesting that you brought up riding in one of these vehicles in the San Francisco Bay Area, because it's not fairly common here in the U.S. to be able to ride one of these vehicles. So how was your experience?
I mean, again, I thought it was absolutely awesome. I rode in 4 Waymos. The company gave me a press pass to try some of them out myself, and I think price point pretty comparable to a standard Uber or a standard Lyft, but the experience is pretty wild. It shows up, your name is flashing. You got all these little gadgets and gizmos telling you to put on your safety belt and this and that. And like I said, even on the very steep hills of San Francisco, California, it's amazing how safely these cars can proceed through intersections, can take in all of the data around it, and really make for a really holistic rider experience. It was unlike anything else I've ever done. It's pretty neat.
Yeah, it is pretty neat. And
Yeah.
I think a lot of us here in the U.S., we might not be as comfortable jumping into one of these vehicles, but we think about other areas of the world, in particular Asia, where people may be more comfortable jumping into these vehicles, and we'll see where this technology goes in this country. But as we head into the weekend, JD, we're already looking ahead to next week. And as someone who follows politics, I'm sure you're closely anticipating and watching that September 10th debate between Kamala Harris and Donald Trump. And that will be taking place at 9 p.m. Eastern Time on September 10th. But I do want to ask you, before we jump into that, so Donald Trump, he spoke yesterday here in New York at the Economic Club. He is still here in New York, expected to be in court, but he's also expected to issue a press statement at a conference at the Trump Tower today in New York City. So what do you make of some of the comments he made yesterday? There's been mixed feedback on that.
It definitely has. As Donald Trump, the former president of the U.S., is known to do, he takes a series of personal swipes at his political opponents. He is framing his opponent in this race, incumbent Vice President Kamala Harris, along the lines of communism and big government grabs, and I think that this price gouging thing that Harris had tried to do was very much manipulated by the Trump side of things to make people think it was maybe some things that it wasn't. But it was a fascinating relationship emerging between Donald Trump and Elon Musk, and you're seeing that more and more reflected in some of the, if not economic, regulatory announcements from Trump. And that was something he talked about yesterday at length, indicating that he's got an idea, basically, that came to him from Elon Musk about a new regulatory approval to cut down on government red tape, and that Elon Musk himself, incredibly, agreed to head it up. So it's maybe a bit of an unlikely relationship, and I argue that because historically, Donald Trump has been a fierce critic of EV self-driving technology, but EVs or self-driving technology, but EV cars, the electric vehicle space, so important to Elon Musk, and they have found their common ground, and Musk is now full-throatedly endorsing the Trump campaign.
Well, it's a very interesting relationship, JD, as you mentioned. So as we edge closer to the presidential election in November, I'm sure we'll hear more about those two on social media as well as in the media.
Oh, yeah, absolutely.
So, JD, I also want to ask you about Democratic presidential nominee Kamala Harris. She is set to meet with Teamsters, and that is expected to happen after the presidential election. So what can we expect out of this? And tell us about the significance.
Yeah, of course. Well, the fight for union labor support and those endorsements is on between the Trump as well as the Harris campaign. Of the 10 biggest unions, the Teamsters are the only one who have yet to endorse Kamala Harris. They still very much may. So I know the Harris campaign is very much looking forward to that meeting. But Sean O'Brien, the head of the Teamsters, we can't forget, took a very rare step earlier this summer, agreeing to speak at the Republican National Convention. We really haven't seen that in modern history before, but saying, I was invited here, I'm always open for a good faith conversation. So to watch the two campaigns try and position their potential economic policies to speak to union workers, which gets to another big story we covered this week, the Nippon Steel, U.S. Steel back and forth, Biden's efforts to block it, Trump's interest in blocking it, Harris coming out saying that she would block it. These are clear plays for that union support. So that meeting between Harris and the Teamsters will be really important as she seeks to secure that union endorsement, which is well over 1 million members in the United States. And these members, they're not just all throughout the 50 states, they tend to disproportionately be in places like Wisconsin, Michigan, and Pennsylvania, arguably the three most important battleground states to win the presidency this year.
Yeah, and JD, I'm glad you brought up U.S. Steel, because in today's session we are seeing shares of the company up by 6%, and that is off the lows that we saw earlier this week. We'll still have to see how this story develops, but for our viewers out there who may not be familiar with some of the issues at hand, can you tell us what's going on there?
For the U.S. Steel story? Yeah, absolutely. So, I mean, a long story that I can make as short as possible. U.S. Steel is an iconic U.S. manufacturing brand. We talked about yesterday the fact that it first traded here at the New York Stock Exchange all the way back in 1901. It's got an incredible history. It was a long-time component of the Dow Jones Industrial Average. But unfortunately, as happens, times change. The ability of a company to scale and stay competitive in the global arena as technology changes also shifts over time, and so the company was in a position to mostly be acquired by Nippon Steel out of Japan, one of our most important geopolitical allies on the world stage. But we've seen a lot of pushback, a lot of frustration from the union groups that are involved with this deal, with the two presidential campaigns now both saying we would block the deal, and both U.S. Steel and Nippon Steel saying, yeah, but we negotiated this in good faith. We really think it's to our benefit to have this deal move forward. Nippon Steel has said, right now we have our U.S. headquarters in Houston. We'll move that to Pittsburgh. We'll play up the Pittsburgh and Pennsylvania components for both campaigns to try and sweeten the pot a little bit. But for right now, there's still a lot of consternation about this deal, which right now appears as if it is not going to go through, much to the frustration of both companies involved.
Well, that's a story that we'll keep our close eyes on as we head into next week as well. So thank you so much for telling our viewers what's going on.
Of course, yeah, it's a really important one.
And of course, I do want to bring up a market check right now, since we are seeing the Dow, NASDAQ, and S&P 500 all lower in today's trading session. The NASDAQ is extending losses down by 2%, and we have the Dow chart up, and that is up by 0.8%. And we're also seeing the S&P 500 down by 1% as well. So we did get that non-farm payrolls report number, which was lower than estimates this morning, but still showed a gain of 142,000 in the latest month. Meanwhile, the unemployment rate ticked lower to 4.2% from 4.3% in the previous month. So JD, I do want to move on now to some of the stories that we're watching. And Warren Buffett, who turned 94 last Friday, which is hard to believe. Yeah, happy birthday to you, belated birthday. But apparently Buffett is once again trimming his stake in Bank of America, and it's a significant stake at that as well. So tell us what's going on here. Why do you think he's doing this?
Well, he hasn't said why he's doing it just yet, and that'll be interesting to listen to close guidance from Berkshire Hathaway about what their exact thinking was. So we do know some of the financial details, even if we don't exactly yet know the rationale behind them. Selling an additional $760 million worth of B of A shares since Tuesday alone. Now, despite this, it's worth knowing Berkshire Hathaway still remains the largest shareholder of Bank of America, holds about an 11% stake. That stake is valued at nearly $35 billion, so it's not exactly as if this is an exit stage right or unceremonious, a dumping of all the support or all the shares or all the stock, but it'll take some time, I think, for the company, for Berkshire Hathaway, to give us a little bit more clarification as to their thinking as to why they move forward with this. No public explanation as of yet, but I think we are seeing shares of BFA down about 1% today, still up about 15 to 16% so far year to date. So right about the overall S&P 500 market average. It's a really interesting story, though, I think.
It is. And Buffett did start investing in Bank of America back in 2011 when Berkshire Hathaway purchased $5 billion of preferred stock. But when we look at Berkshire Hathaway stock, you and I were both looking at where shares are. It's not quite cheap, is it?
Yeah, no, definitely not, especially relative to how much you can get for an average share price of a lot of other comparable companies, but other proponents would say there aren't really comparable companies to Berkshire Hathaway. There's one Warren Buffett, there's one Berkshire, and not a cheap stock, but gives you an indication it's not really a tech pure play stock. It's not really a real estate company. It's a bit of everything, but still has one of the largest market caps in the world. Berkshire Hathaway is an incredible story.
And for those of our viewers who may not be familiar with how much one share of Class A or Class B stock trades, let's take a quick look to see what we're talking about here.
Berkshire Class B right now is trading at $4.63 a share. And again, you're talking about a stock that year to date is right now up 27%. It is down fractionally on this day. Class B shares there for Berkshire, $4.63. Looking here at its all-time, yeah, it's pretty close to trading right about its all-time high. Looks like its all-time high was just really just coming off in the last few weeks. It went up to almost $4.80.
Yeah, so that is definitely not a cheap stock for sure, JD. So very quickly, I do want to go over what we saw in terms of the jobs number this morning. So just to reiterate, we got the latest employment report for the month of August, and non-farm payrolls, the headline figure, did come in below expectations at 142,000 versus a higher number above the 150 and even 160,000 level. So what did you make of that report today?
Lighter than expected, but it could definitely have been worse. I mean, we came off a number yesterday with ADP that was at 99,000. The expectations had been for about 162 to 165. To see another number in a row for a second consecutive month come in softer, not an overall surprise, but I think maybe it's a bit of a sweet spot, right? Because unemployment fell down to 4.2%, reinforces the Fed's path forward in terms of a potential soft landing scenario, I think. The overall deterioration of the labor market conditions is something the Fed is going to increasingly focus more and more on. But we can't forget that largely the sell-off that we had in early August came off of the July's jobs report, which was really disappointing, at only 114,000 private non-farm jobs that have been added for July, and that was really a shock, really, to the system. So I don't get the sense that today's movement is necessarily in direct response to that, but again, we're just seeing a lot of kind of cyclical profit-taking through the first 4 days of September. So I don't know if this will move the Fed closer to 50 basis points of a rate cut on September 18th. I think 25 is still probably more realistic, and that appears to be what traders are betting on today. But I think it's the sort of jobs report where you say, not the best we've ever had, but it certainly could have been a lot worse, especially given where ADP was yesterday.
And as you mentioned, we got ADP yesterday. We got a slew of labor market figures out earlier this week. But it's always so interesting to go through the non-farm payrolls report to see where the jobs are coming from and also to see where some of the losses are. And apparently healthcare as well as construction were two sectors that saw gains versus manufacturing, which saw losses. So what do you make of that, given some of the other labor market reports we got out earlier this week?
I mean, manufacturing sector is continuing to slide into contraction. It's not a big surprise there. I mean, even I think if you have month-over-month numbers that might move one way or the other, I think all the numbers you just listed give us to the overall state of play where hiring is decelerating, the manufacturing sector is starting to show chips, and there are kind of chips that are emerging throughout parts of the economy. We're seeing those cracks happen, and I think despite the overall resilience of the economy, concerns of the job market do specify. I don't look too closely personally or read too much into which sector did better in the economy than any other, because there's so many cyclical or seasonal factors that are at play as well. We expect certain parts of the year for hospitality to do very well. We expect certain parts of the economy like retail to do very well in the fourth quarter of the year as we get closer to the heart of the holiday shopping season. So overall, I think you take the anecdotal pieces of information, as Jay Powell likes to say, but you have to know when to step back and put it in the broader mosaic of the aggregate to really give us a sense of what's going on across the state of the labor market and the state of the U.S. economy.
And I'm glad you brought up the holiday shopping season, because if we go to some of the big name retail outlets here in the United States, not only are we starting to see some of those Halloween decorations, but we're seeing Thanksgiving as well as Christmas. But I've noticed this every year since the pandemic kicked off, that we're starting to see earlier seasonal products in the stores, and I think that's sort of indicative of how these retail outlets are trying to attract more consumers to buy. But what do you make of that? Are you already planning for Thanksgiving, Christmas, Halloween? Too soon?
Too soon. As long as we don't start seeing like Valentine's things in the store in September, then I guess I'm okay with it. But yes, it is a little jarring, because you walk into a store and you're like, I'm not mentally ready for the Christmas season or the heart of the holiday shopping season. But I do understand for retailers. We understand the struggles of both the big box retailers and the mom and pop brick and mortars as well, just trying to kind of generate any bit of enthusiasm for a consumer base. I get why the companies do it, even if it makes us all kind of groan and roll our eyes a bit when we walk into a place like CVS and say, all right, I get it, I'm not quite ready for Thanksgiving just yet. So to answer your question, no, I won't be shopping for the holidays for at least another month or so.
Well, it's interesting because we've been hearing about potential supply chain issues when it comes to unions as we head into the holiday season, but that is a topic you and I can dive into as we get closer to that. So JD, it's been a pleasure hosting you here at the New York Stock Exchange this week. I wish you a happy weekend.
You as well. Thanks for having me this week.
Thank you very much.
Good to be with you.
And next up, we will be joined by Tai Wong, independent proprietary trader, to dive deeper into the employment report. We'll be right back. Welcome back to Global Money Talk live from the New York Stock Exchange. And joining me for the second half of the hour is Tai Wong, who is an independent proprietary trader. Thank you so much for joining me.
Good to be here again.
Well, here we are on Jobs Friday. We made it through the week, Tai.
Yes,
so
we did.
Right, and although it's been a holiday shortened week, it does feel like every single trading day this week we had a lot going on. So we got the U.S. jobs report finally, an event we've been anticipating all week. We got that non-farm payrolls figure. It did come in below estimates, but still holding well above 100,000, coming in at 142,000, and the unemployment rate also ticking lower. What was your take on it initially?
Oh, you're absolutely right in that it feels like a holiday shortened week, but it's been a long week. I know my youngest kid just went to high school for the first time, and so we've had a lot of data this week, a lot to digest, but everybody was focusing on today's data. And today's data was, and we'll get into it, it was a little bit more later on in depth, but my sense is that if the market was looking for steak, they got kind of a side salad. So the payrolls number was lower than expected, revisions were lower, but both of those were sort of expected. But then the unemployment rate also came in, ticked down 0.1%. And the market, the headlines all talk about the unemployment rate, I think more so than payrolls, at least for most investors. And then finally, one part that's important is the average hourly earnings ticked up 0.1% from 0.1% higher than consensus at 0.4, and that can suggest a little bit of inflation maybe lurking. So I think it's going to put the Fed in a situation where I think it's going to be 25 basis points, which is why I said the market was hoping for actually really bad news to be good news, so they get 50 basis points. At this point, I don't sense they get that.
And speaking of the market reaction here at the New York Stock Exchange following the release of those figures, we're looking at future prices, and then the market opened at 9:30 a.m. And initially we saw mixed trading for the major averages, but right now at the 11:30 hour, we are seeing the Dow, NASDAQ, and S&P 500 all in negative territory, with the NASDAQ down 2%, the S&P down 1.4%, and then the Dow Industrials down triple digits or over 300%. So it's really interesting to see how the market price action has shifted just in the morning session. And I think it does speak to what you just mentioned, because expectations were different heading into today's session based on people who thought potentially we could get a 25 basis point cut versus a 50. And ahead of that September 17th Fed Reserve meeting with the rate decision coming out on September 18th, we will keep an eye on what the Fed speeches say before their media blackout period, which begins today.
Absolutely right. And it's interesting because the market, the fixed income market and the stock market, they're kind of bifurcated right now. The fixed income markets have had a huge rally. So suggesting that they think that maybe fixed income traders think that, oh boy, this is a really poor number and the Fed is going to go 50 basis points. But the stock market, if the stock market thought that, I think the stock market would be flat or up on the day, and it's not. So, and we're still, it's only 11:30 or so, give or take, and it's plenty of time before the end of the day. It wouldn't surprise me if stocks came back a little bit towards the close, as strong as the bond market is. And the bond market, there's a lot of issuance coming down the pipe. So for the bond market to show this strength, they're definitely thinking a little differently. And just minutes ago, Fed Governor Waller, who's something considered a weather vane for the Fed, came out and said he would be open to larger rate cuts if the situation warranted. So I think he put it out there, but if you read into the speech itself, he's not saying September, he's saying if incoming data warrants it, we'll have it. He's let it out there. Let's see how the market finishes up, but the market's a little bit confused right now, depending on where you're sitting.
And just looking at the market action across the board, so you mentioned bonds, and we'll be keeping an eye on yields as well, but even the way that the stock market here in the U.S. for the major equity averages reacted, you can tell that there's a lot of mixed feelings when it comes to the details of this jobs report.
Absolutely, absolutely. It's a good day to probably dive deep into sort of the employment report.
Yes, definitely.
If you could bring up graphic 1A, if that's available. This is graphic 1, which is absolutely fine. What this shows is, and I took this shot before the data came out, but it shows this is a really good website, by the way, Trading Economics. It's free. It tells you data for every country. I have it just focused on the United States here. It tells you 1A, or 1 if you don't have it. So it's it shows you the consensus, the forecast, and the previous. The consensus is really the one that you want to look at. Forecast is merely trading economics forecast, which I'm less interested in because I want to know what the whole market is looking for. So this said the market was looking for 160,000 jobs. Some said 165, but right there, unemployment rate of 4.2%. Average hourly earnings they were expecting 0.3. Right? So we got 142. We got 4.2 in the unemployment rate, and average hour earnings, as we mentioned, ticked up 0.1%, which is important because it's a mixed report. It's not as weak as they would like it. And so this has been for 35 years, for as long as I've been in the market, this has really been, except for very brief periods, the most important number in the market. It's the first Friday of every month at 8:30. Except if the first Friday is the first of the month, it's not enough time for the Bureau of Labor Statistics to actually get it. So if the first is a Friday, it will go to the 8th. And this is the things that I remember after 30-some years in the market. This is what you absolutely know. So let's move to graphic number 2. Why is this number so important? And it's been occasionally we've had the CPI number more important, like the last couple of years before the last 6 months or so, because CPI was telling the Fed how much to hike. But once we get off that cycle, this becomes a really important number. So why is it so important? People say it's a lagging indicator. It doesn't tell you what's happening with the economy right now. That's true, but it's politically in the United States, and I think in most places, the most important issue is jobs. So the Federal Reserve has a dual mandate. They worry about inflation occasionally when it's high or when it's quite low, but really it worries about jobs. And jobs drive U.S. monetary policy. They're the quickest to react to it. Fiscal policy takes a lot longer because it involves Congress. But if you consider that the U.S. has 70% of the world's investable sovereign bonds and 60% of the world's global stock market capitalization, the U.S. economy and the Federal Reserve are really important to the world, and this is why this is such a number. And then, so for me, it takes on a special significance, and people joke about it. We go to graphic 3, and this is just a personal thing, and that my colleagues and I laugh about. So this is a counter that I made on one day, and it says 95. That is how many payrolls reports I have left until my youngest child graduates from college. It actually will be flipped to 94 as soon as I get home today, because that's how many more payrolls that we have. So we look at, I look at our, I can measure my life in payrolls, and it is a really important number. When I started in this business, people were not allowed to take vacation on payroll Fridays. You couldn't do it. It was just irresponsible in terms of when a market is that busy, you cannot be out. You cannot be off.
I think that really speaks to how many employment reports you have experienced and witnessed. But I also like that graphic that you have as well. You have the map of the United States, a flag of the United States, and that countdown clock. So that's very interesting that you have that
sense of humor, right? You need sort of humor in this market. I mean, I remember J.D. was just talking. Tesla was up 6% yesterday, and it's down 4% today. And sometimes you get really big moves, especially on payrolls Fridays, and you've just got to laugh a little. If you don't laugh a little, this shop can get real serious and too fast.
Well, I think that number 95 up there really speaks to your dedication, Tai, because we know that work ethic has been shifting across different generations. So perhaps in this environment where we actually do have work from home policies, perhaps people will be somewhere else and not quite chained to their desk at the office.
It's true, and it's changing, and sometimes it's a good thing, right? Before the pandemic, we never realized that we could work from home. And if I work from home every day, I save 2.5 hours of commute. And invariably, some of that time actually goes back into the office.
Yes.
You spend more time in front of your
Absolutely.
screens because you're comfortable and you don't really have to do all that traveling. So I think it's a good thing. Though I still sometimes get annoyed. I remember at one of my jobs, they would invariably schedule a call at 2 o'clock on Wednesdays, and I'm like, that's the Fed.
Yes,
8 times a year. Can we
2
not?
p.m. Eastern time.
Can we not do that? So it's not the old habits of you want to know exactly what's coming out and be attuned to it, not be distracted.
Yeah, and speaking of which, Tai, you mentioned 2 p.m. So after the Federal Reserve's 2-day meeting, September 17th to the 18th, that long-awaited, highly anticipated rate decision will be coming out at 2 p.m. Eastern time.
Exactly.
And we'll be listening for Powell's comments in the presser following that.
Absolutely. You look at the dot plot, and then you listen to the presser with Powell, and Powell's gotten really good at this. I know in the beginning he would say things, and the market would go. And he's gotten really, he's been a really good Federal Reserve chair, I think. And he speaks in a way that just people understand, which is really important. But it's not, because Jay Powell is not just for, folks like us, it's for everybody else too. So to have someone who could, that the regular people couldn't understand is great.
Yes, and absolutely. When we think about many years ago when we had these key events like the jobs report or the Fed rate announcement, we didn't always have smartphones, right? We might have had technology in the form of the web or laptops, but nowadays someone like Jay Powell can become a meme almost immediately after the presser, right? So that sort of speaks to how the culture has changed over the decades and how our access to information is there. So it's not just people like you and I, people who work in financial services or people in the media. It's everyone out there who's looking at social media platforms and they're like, oh, Jay must have said something important out there. So I think that's also very interesting to monitor.
I think Jay Powell, one thing he doesn't want it to be is a meme, but it's inescapable. But he doesn't want to be a meme. He also doesn't want to remember 50 years ago as an object lesson. I think that's how he's going to approach. He's approached his time at the Fed, and I probably will continue to do so, which is good. Keep things nice and steady.
And I can't imagine Bernanke, for example, becoming a meme, but that does speak to how long you and I have been covering the market.
Yes.
So shifting our focus on back to jobs, let's take a deep dive into the unemployment rate. So as you mentioned earlier, we did see the unemployment rate in the U.S. dip down to 4.2% from 4.3%. And if we rewind a little bit to the beginning of August, right? We had that market volatility on August 5th. We saw all the major equity averages, a lot of assets just see red across the board, and that was in reaction to that unemployment rate, which you touched upon earlier.
Right. So perfect time for a deep dive into non-farm payrolls report, which primarily has 2 sections, and we'll get to the unemployment rate in just a second. But let's first go to graphic 4, and we can talk about the non-farm payrolls. So this is actually what we said, 142,000. It's actually the change in non-farm payrolls. Impressively, the total non-farm payrolls in the United States is something like 157 million people. So it's a lot. So that change is, a tenth or 0.2%. But that sometimes we forget that the base is actually quite large. So, like I mentioned before, and we can see in the graphic here, ignore the forecast, but look for the consensus, which is basically the average of the sell side forecast or everybody's forecast, 160,000. So when this comes out, when I'm sitting in my chair, I look at that, and then I look immediately at the revisions, because sometimes the revisions can be down or up versus what the number is. The revisions were down today, substantially. I think it was maybe like 89,000 over a couple of months, 25,000 the last month's number, which made last month's number under 100,000. So look at the revisions. Previous to that, the last 2 months' revisions were 29,000 jobs. Now, what's important to remember is non-farm payrolls, that this number is taken from what is called the Establishment Survey, which is a survey of a sample of 120,000 businesses. And it's considered to be a very reliable number. And it's a number that makes the headlines, and the professionals really look at this number. The headline number is going to have the most impact, but the net number overall as the market digests it. But that's non-farm payrolls. And I think about it, I have 95 more non-farm payrolls until Catherine graduates from college. So let's move on to the unemployment rate, which is the second half, which is just as important. So graphic number 5. So the unemployment rate actually comes from a completely different survey, and it's called a household survey. It's a survey of actually only about 60,000 what they call eligible households. And I took exactly what it is from the Bureau of Labor Statistics. It says it includes the unincorporated, self-employed, unpaid family workers in family businesses, agriculture, and related workers, workers in private households, and workers on unpaid leave. So these are sort of people responding to a survey, families responding to a survey, and they're going to be less reliable than businesses. It's also a smaller sample size. So they basically take sample sizes and gross them up and do a lot of fun actuarial complicated stuff that's far beyond me to figure out what the number will be. So in the past, it makes the biggest headlines. You look at the Daily News, you look at the Post, and you even look at the Times. They'll talk about the unemployment rate, but it's more important now because Jay Powell and the Federal Reserve cares about it. And I think they care about it because it gets a lot of attention, and people care about it. So if you talk about non-farm payrolls, I think that the ordinary investor would be, what's that? But they understand the unemployment rate because 4.2% of the people out of work is something that they can understand. And the unemployment rate has also gained extra significance in the recent couple of years because of what's called the Sahm Rule. So let's move to graphic 6, and we'll look at Claudia Sahm. So Claudia Sahm, pictured here on the right, was a long-serving Federal Reserve economist. I think she was there over 10 years. She's since moved to, she started, I think, a consulting firm. I think she's with the Jane Family Institute right now, which is a family institute of somebody who's running a big hedge fund. And she came up with, during her time as an economist with the Fed, she came up with the Sahm Rule. And the Sahm recession indicator, according to the Federal Reserve Bank of St. Louis, the second bullet point there, signals the start of a recession when the 3-month moving average of the national unemployment rate, U3, because they measure it in different ways, rises by 50 basis points or half a percentage point or more relative to the minimum of the 3-month averages from the past 12 months. So basically, if the moving average goes half a percentage higher than the lowest of the average of 3 months in the past year, it signals that we are either in a recession or going to be in a recession. And as Claudia Sahm explained, since 1970, the rule has correctly predicted every recession and has not been wrong in that time. And it triggered last month, and it ticked up to 53%. And with today's data, it actually ticked up to 0.57%. So now, she's been very careful because she's gotten a tremendous amount of attention, and I think sort of deservedly so, because this is something that people can understand, and she developed it as an early warning indicator to what she said would be for the government to add stimulus to the economy. But it's also equally useful, perhaps more useful, for monetary stimulus because the Fed can move a lot faster than Congress. Now, she has said, because of all the attention, that this is not, the Bible. It is not always going to work. And in fact, the fact that we've had higher participation, which has brought the unemployment rate higher, and as well as a historically low unemployment rate may cause this to not work this time. She has said that. But I like this rule. I want to keep an eye on it. I think it's pretty good.
Well, Tai, thank you so much for that deep dive into non-farm payrolls as well as the unemployment rate, because I think it's so helpful for viewers to understand the significance of this data, this report that comes out every first Friday of every month. But I think it's also important that you brought up the Sahm Rule, right? And the fact that even Claudia Sahm herself has said that this is an empirical regularity and it's not a law of nature. And when she came up with this originally, she wanted to automate stimulus checks. For those who may not be familiar with this, Tai, can you explain why this is so significant?
So I think the idea of stimulus checks, and I guess people understood it more in the pandemic in terms of when a lot of people became unemployed very, very rapidly, and to an extent that we had never seen before, and from which we rapidly recovered, due in part to the policies, the stimulus of the monetary and fiscal policies, compared to the Great Recession, which took a long, long time to recover from. And I think we took some lessons from that. But I think the idea was to tell the fiscal authorities that we are either in a recession right now, which again, a lagging indicator. A recession technically is a shrinkage in GDP for 2 straight quarters, which is also a very, very lagging indicator, and says, why do we want to wait maybe 6 months before we help people out? Let's do it a little bit earlier. So this is, it makes a lot of sense. It's just Congress doesn't move that quickly, and to add checks, stimulus checks, is a difficult thing. But I think it's actually useful for the Fed, as we're going to find out perhaps over the next few months whether we actually head into a recession. I think it's a good rule, even if it doesn't work this time. And sometimes, though, it may not work all the time. When you have a rule that works every time for every recession since 1970, sometimes you may have fit the data too cleanly to make sure that everything works. So sometimes a rule is better if it works 80, 90% of the time than 100% of the time, because it's a less tight rule. And I remember Dan Ha yesterday saying that if he doesn't like coin flips, but if you gave Dan 80 or 90% chance of something working, he's going to elbow me aside to trade. He'd be so quick at it.
Well, I think that's a very interesting insight you provided with us, Tai. And as you mentioned, we have to keep in mind that cases such as the pandemic that we just all experienced starting in March 2020, that is a once-in-a-lifetime event. So we have to take into account the differences as well as the outliers in this case.
Yeah.
And next up, we do want to take a close look at the rest of the employment report that came out in the U.S. for the month of August. But very quickly, let's take a look at where markets are trading in New York Morning Trade. So we do continue to see red for the major U.S. stock averages. When we look at the Dow Jones Industrial Average, it is off by triple digits, down by over 350 points, or 0.9%. And the Nasdaq Composite Index is extending losses from earlier in the session, down by nearly 2.5%. And it is off by over 400 points. The S&P 500 is also lower as well, down by nearly 1.6% at this 11:30 hour, and is hovering above the 5,400 level. So, Tai, we are seeing extended sell-off here in New York Morning Trade for the major U.S. stock averages. So I think this is a good time right now to take a deeper dive into that jobs report, because it's not just the unemployment rate, the non-farm payrolls, but there are other juicy details. So tell us what's going on.
Sure. Let's look at the rest of the report. Graphic 7, I called it the rest because there's some important bits, but they're worth looking at. So in the red boxes, we have average hourly earnings. So that's important when you're really worried about inflation. So a year ago, 18 months ago, when inflation was raging, the Fed was looking very, very closely at that because they were afraid of a wage price spiral, that because we're coming out of the pandemic and participation was down, and there were 12 million job openings on JOLTS, that people would demand and get more and higher wages, and that would drive prices higher. That has happened in the past, or something they're really afraid of. So with inflation tamping down right now, they're not so concerned about that. The participation rate had gone up in previous months, which means there's more people looking for work, so the unemployment rate sort of looks higher. It stayed flat today, so I think they'll keep an eye on that, but it'll be a little less important going forward. What's important, when we think about it, it was a participation rate. It tells you a lot about a country's job population. So the participation rate was much higher 10 years ago. It was probably somewhere in the range of 66 to 67%. And what that means is probably demographic, that we've had the baby boomers, the last baby boomers are starting to retire, and the pool of available workers is actually smaller compared to the population, which is why participation is down. And then finally, at the very bottom here, is the U6 unemployment rate, which is the underemployment rate, and it tells the market, it tells the Fed that for people who have a job but they don't have a full-time job, but would like a full-time job, how much that is. That is still relatively low compared to where it's been over the past 15 or 20 years. So not really a big concern, but something worth taking a quick look at. And then finally, the stuff in the middle, obviously, private payrolls are more important, I think, than government payrolls, because private payrolls means somebody is growing the economy, whereas public payrolls is really just the government going. The government doesn't often produce stuff and add to GDP, so really private payrolls can be important. But this is the rest of the report. The most important, as we've gone through before, is the payrolls and the unemployment rates.
Well, Tai, I think this is very helpful, and for you to go over each individual line item. And I'm glad you brought up the U6 number, because that is something that we have been keeping our close eyes on. And I'm sure this entirety of the jobs report will be a topic that we'll be hearing in that presidential debate coming up next week between the two candidates. Yes. Because, as you mentioned, jobs, right? The economy, these are key things that Americans are paying attention to.
Absolutely, especially in sort of the so-called Rust Belt states like Michigan and Pennsylvania, where people in the last election, 80,000 people literally decided that election. If 80,000 people, the right 80,000 people, so to speak, or the appropriate, I should say, switched their votes in enough states, Trump would have been president again. So that's why there's so much focus on it. So much focus on, geez, why, we don't want to tax tips. And both sides have actually jumped on. I think Trump had it first, and Vice President Harris said, this is a great idea. I want to get on that train as well. But jobs are really, really important. That's what this election is going to focus on.
Yeah, and if we look at the non-farm payrolls to see where the jobs came from, we saw healthcare as well as construction. They saw gains in the latest month, but at the same time, manufacturing production jobs saw a decline.
Right, right. Manufacturing, it's in a tough spot. Other countries just can make things cheaper because they pay lower wages. So it's in a tough spot. So that wasn't entirely unexpected. But it was good that we saw a good private payroll growth. It gives the Fed, I think, a better sense that we can start slow, and if we need to go faster, we can go faster. That's why I do think it's going to be 25 basis points as it stands now.
And Tai, I do want to ask you about your experience with this employment report. So as you mentioned, you gave us that 95 number initially, but what has been your experience? Because when we think about earnings reports, for example, financial services companies, after some of the big names report their earnings, despite what the results are, top line, bottom line guidance forecasts, we might see shares pull back. But in the case of employment reports, historically, what have you seen in terms of reaction across the markets?
Well, let's take a look at, I think it's, let's look at the graphic number 8. And as a trader, so this was actually, wasn't even expected. This was Wednesday when JOLTS came out. And you can see in that yellow oval, gold rallied $10 in seconds. And as a trader, you have to deal with this volatility. So that was a particularly tough one because you didn't expect it. JOLTS is a number they look at, but it doesn't usually move markets this much. So let's look at this morning, and hopefully they managed to get this. So do we have graphic number 9? Sorry, maybe it was 10. I apologize. Yes, this is it. So, I apologize for the because it's a per minute chart and may not be so clear. But when the jobs report came out today, gold moved $22 in a minute. In fact, I watched it gap, and it gapped first lower and then instantly rallied. So, how do you deal with that? And it became an art. As a trader, the payrolls report, I remember I said you were not actually allowed to go on vacation in the early days when this came out, in the early days when I was in the market, because you knew at 8:30 something would happen. Now, the technology has gotten so grand. If we go back to graphic 9 when you have a second, the one before, that would be awesome. You could watch a report and then trade, but you can't really do that anymore because the machines are so fast. I watched a gap and my first reaction was, oh my God, must have been a really strong report.
Interesting.
And then I saw the print and it said, the site I was looking at said, average hourly earnings up 0.7%. It was an error. Right? And I think a machine read that error and said, oh my goodness, wages have really gone much higher. What do we do here? So, and then when they realized that that was an error, gold instantly started to rally. The machines took in the numbers. But I don't look at the update anymore. I actually look at how gold or something else reacts real time, because the market works in milliseconds now. I mean, if it takes a second for the Bloomberg or whatever I'm looking at to update, and a second for me to actually react, it's too late. The market's gone. The market's gone. You might be interested to know that there are certain hedge funds, sort of high-frequency traders, low-latency traders who need to move really fast. They pay tens or hundreds of thousands of dollars to put their servers in the same room with the Bloomberg servers, so they won't be 10, 20 milliseconds late when the data comes out. Because if your server's in Chicago and you're half a second late because of that, somebody's way ahead of you. So it's really remarkable. It takes sort of the human out of the situation. So how do we react to that? I think as a trader, you need to, if you have orders, you need to have your orders in ahead of time. So you have to know when it's coming out, where your orders are, important orders you have to fill. You have to have them in. You also have to be careful not having stop losses. Let's say you were long and you were afraid it would be a good number. If you put a stop loss in the downside today in gold, it would have cut you out at the lows and it would have gone right back higher. So really, you have to be ready pretty much for all the time. And and the last piece of advice I would say is, people, what do you think of this number? Wait till 10 o'clock on every Friday, payrolls day. Wait till 10 o'clock and have people let the market digest.
Well, Tai, I think this is helping us understand the significance of this report and what it means for retail traders out there. So thank you so much for your company this week, and thank you for weighing in on this all-important jobs report.
It was great to be with you this week. Thank you so much.
Thank you, Tai. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro TV. And you can check out the show anytime on our YouTube channel by searching Global Money Talk. And thank you so much for joining us. Have a great weekend.